Stocks bounced today, but are we out of the woods yet? That's what we're going to discuss in today's video. I'm also going to explain why I think stocks rallied today, and I'll share a few of my favorite areas within the market that I like right now for potential longs, particularly if U.S. stocks come under trouble or pressure again. So, if you're new to the channel, my name is Justin Spittler, professional trader. I have a free e-letter you can read over at riskhedge.com. We also have a trading room over there. And then I'm also on Twitter at jspittrades as well, where I share a lot of charts, occasional meme, and just my thoughts on the market. And if you saw yesterday's video, you know a big thing that I was watching was how stocks were essentially stuck below 21-day EMA, or a 20-day simple moving average, whatever you use, they're roughly about the same. And that's still the case despite the rally that we had today, which was encouraging because of how we closed yesterday. If you were watching the market yesterday, if you caught my video, you know that the markets were down a little bit until the Fed announced that it was going to keep rates steady. And then we got a pop on that. And then Powell came out and did his whole thing and had his press conference. And then we rallied off of that press conference. We enjoyed a little bit of a rally. I think the Qs got up to about 1.5%, and then it faded, and we had a really nasty close today. And I was kind of worried that it was going to trickle over, and we're going to see a lot of bleeding today. But we actually bounced, and you can see exactly what I mean here. So on SPY, we bounced, and we're still in this sideways consolidation pattern here, which, in my opinion, looks a lot like a bear flag. And to add to that argument, or another reason why I think that this is potentially a bear flag, is because we are stuck below some key moving averages. In particular, we're stuck below this declining 21-day EMA. So I think that's a bit of an issue. But we did have a nice rally today, and also after hours, Apple came out and delivered their earnings. And I think the earnings were whatever, but they announced a $110 billion buyback program. And you know how investors and Wall Street feels about share buybacks. The stock rallied a ton on the news. I think at one point it was up about 7% on the news. And so, Apple just being as big and as important of a company is, that should bode well for stocks tomorrow. But we'll have to see how this shakes out, because you could see here on SPY, we're still below this declining 21-day EMA, and this still looks a lot like a bear flag. And we're not just seeing that in the Qs in SPY. We're also seeing it in the Qs and a lot of other areas of the market. So you can see here, we're looking at the Qs, triple Qs here, and it's really the same situation. We had a big run up. We had some consolidation, which turned out to be a topping pattern, broke down from that. And now we're having a rebound off this key support level here, but we're coming up into resistance again. So while I'm encouraged by what I saw today, I don't think the indexes are quite out of the woods yet. And you can see this, when you look at a lot of very important ETFs or indexes. So we have the NASDAQ Composite Index, which just gives us a broader sense of how the stock market as a whole is doing. And it's the same thing. What happened today? We rallied up and got rejected by that declining 21-day EMA. So this is still in a vulnerable position, in my opinion. The good news in this case, though, is that we have come down and we have tested a prior higher time frame support level here. So this dates all the way back to the prior cycle highs, and that's holding for now. So even if this breaks down, we may just fall back down to here and consolidate a little bit more. And the market might just need a little bit more time to build up energy before it can head higher again. But I think we still have to take this formation, this potential bear flag formation, very seriously, because we're also seeing an RSP. This is the equal weight S&P 500 ETF. We're seeing in the equal weight Qs, same thing, run up, consolidation, which turned out to be a topping pattern, broke down from that, and then we just have this potential bear flag forming. XLK, same thing. We'll have to see how this looks tomorrow, how it closes tomorrow in particular, because Apple is about, I think, 22% of XLK. It's a huge component of the tech sector. And you can see even after hours with the impact of Apple's earnings, we're not above that declining 21 EMA yet. So we'll have to see if the bullishness around Apple's earnings announcement or really buyback announcement, feeds into other areas of the market and can get some of these key indexes and ETFs back on track, because we're not quite there yet. Same thing with semiconductors, stuck below that key level. I have another semiconductor ETF here. This is SOX. It just gives a little bit of a different view. Essentially the same setup. But we could see here as we had this triangle pattern form, broke down from that. Now we're rallying up against it and still have yet to get back above this 21-day EMA. But I think it'll be interesting to see if we can reclaim this. We could move higher in a hurry, because then I think that would confirm that this was a false breakdown in SOX. And I think if we see it in semiconductors, we're going to see it in other areas of the market. But what really drove today's price action, because as I mentioned at the beginning of this video, the late afternoon reaction to the Fed, or I don't even know if you want to attribute it necessarily to what the Fed said yesterday, because I don't think the Fed or Powell said anything particularly surprising or interesting during his press conference yesterday. But nonetheless, we had this move that sort of looked like a trap. It looked like, oh, we're going to suck some people back into the market, get them excited, get them bullish again, and then we're going to pull the rug. And that's essentially what happened. But it didn't. We didn't see continuation or follow through today. Instead, stocks did very well. I think a big reason for that is because the dollar, which has been strong and kind of a thorn in the side of the market as of late, is showing signs of being potentially local toppy. It's starting to run out of steam here, and you can see in this case it's breaking down below its 21-day EMA, which was rising, and we've just had several days of sideways consolidation pattern. This it just looks like distribution. We're over on the 4-hour candles here, and you can just see it a little bit more clearly that we've traded sideways and now we're starting to roll over and break down. And I think, regardless of what Apple did, I think it'll be a bigger bullish catalyst if the dollar could roll over and head higher, or head lower from here. So this would be the main thing that I would be watching. Apple's announcement is good and all, but I think it would have been more bullish for the broader market if Apple was rallying a ton after hours, because it crushed its earnings estimate or crushed its revenue estimates, or even said some really, really bullish, exciting things about AI. But it seemed that the bulk of the move was driven by this buyback announcement, which is very company specific and doesn't really speak about the broader market, or in my opinion, the broader tech sector or the consumer. But nonetheless, we'll keep a very close eye on Apple because it is, it had come back down into a key support level here. Looked like it was going to break down and head materially lower, but we had a strong reversal off that. And now we have the earnings announcement. And, I think whether it's because of buybacks or whether it was because of, good fundamentals, I still think it would be very encouraging and bullish for the market if Apple can head higher from here, at the very least stop falling, because you could see, for basically all of this year, actually going back to December of last year, Apple's been falling, and the market has done very well in spite of that. And I think the market could, do a lot better if Apple stopped falling and started participating. So that'd be something to watch. But because there's so many question marks surrounding the indexes right now, I think it makes it a little bit of a tricky environment to swing trade U.S. equities. There's tons of individual names setting up that I think are very, very interesting here. But I want to see a little bit more support from the indexes and these sector ETFs, these industry ETFs, such as the semis, because it's just so much easier to trade and gain traction when you have the indexes at your back and the tech sector at your back. You just have more tailwinds to work with. It becomes easier to trade. But if we are in a situation where U.S. stocks fall a little bit more and this correction continues, I still think you could make money on the long side. And one way I'm thinking about doing this, and I have started to do a little bit more of this as of late, is looking outside the U.S. and looking at other countries. And so emerging markets right now have my attention, particularly China. And China's been dead money, a bad trade, an area of the market that's really underperformed U.S. stocks for quite some time. But you can see since really the start of this year, the FXI, this is the large cap China ETF, has been on a tear lately, and it's massively outperforming the S&P 500 and the Q at this point. And Chinese internet stocks are also looking really good. You can see the big move that we had in KWEB today. This closed up almost 8%, so a really huge move, and it's breaking out to multi-month high, almost the highest level in a year. This is going, back to really August of last year. So that's very encouraging. So China could be an area of the market that could, do well if U.S. stocks continue to struggle. Because there's always a bull market somewhere. Right now, China is an area of the market that's working. One name that I shared on Twitter recently that I really like, I think it looks really, really good, really constructive, is Futo Holdings. This is used to be a fintech favorite, actually based in Hong Kong, but nonetheless, it's trading in sympathy with Chinese stocks and emerging market stocks. And you can see here that we have a really constructive longer term chart. I'm going to flip over the 10-week on here. You can see that we bottomed all the way back in March of 2022, so well ahead of when the U.S. indexes bottomed. And since then, it's just been basing out and, very early stages of an uptrend, but essentially a base because it's, it's been more or less trading sideways, although grinding higher with a series of higher lows. And now we're starting to break out of that. Let me throw this trend line on here. It has broken out of a downtrend that it's been in really since late 2021. So that's very encouraging. And now we're breaking out to the highest level in well over a year. So this is really encouraging. If we had a close like this would be, I think this could be the start of something major. It ran up today, I think about 12 or 13%. Yeah, it ran up 12% on good volume. And you can see the volume that's been coming into this one lately. So depending on your style, I don't know if this is something that most people will want to chase, but I think it's something to keep a very close eye on, to see how it consolidates and see if it can set up for a good entry up here, because this is looking really, really good on the weekly. GigaCloud Technology is another Chinese name that I'm watching. You can see how strong this name's been as of late, had this massive run up, and then it's just been trading sideways for about a month or so, a little over a month. Looks like we had a little bit of a shakeout. Looked like we were going to roll over and head lower, but then the past 2 days we've had a strong rebound, and now we're back above the 21-day EMA. And tomorrow we could potentially reclaim that 10-day moving average as well, and we could also potentially close the week green because we're only down about 1.84% on the weekly candle so far. And I think that would be really, really constructive. And this could set up for a big move higher. It's been a very strong name as of late. Huya is another Chinese name I keep an eye on. This is a social media company in China. And the thing I like about this over names like JD and Baba is just how fleshed out this base is. You could see that it bottomed back in late 2022. Had this initial run up, it's just been trading sideways, and it is now starting to wake up again. In my opinion, you can see that it's flipped this key level here after had this nice run up, pulled back into it. The rising 10-week moving average caught up to it, and that's starting to act as support. And so this looks really good, and you can see how far it is off the high. So in my opinion, this could have some nice upside potential going forward. Coupang is another name. This isn't a Chinese name. This is a Korean name. But, when Chinese stocks move, a lot of other emerging market stocks also tend to move. And this is also, same region of Asia. And you could see, once again, that this is starting to emerge of a really nice base. This bottomed back in May of 2022. We had a big breakout on volume recently, and we've just been consolidating mostly for this week. And we're down about 1.8% on the week. But this one, because it had this big run up over the past prior weeks, I think this one could require a little bit more time. But overall, it's looking really solid. And this was one of the names that was working before the other Chinese names started to really wake up. So I like the relative strengths from this one. And then India, I think, is another area that you could look at if emerging market stocks start to do well. Again, This is Make My Trip. This is a name that has been doing well for quite some time. And it's easy to see why it broke out of this massive base that goes back all the way to about 2010. So this is a massive base. We broke out of it. And, when stocks break out of, huge bases like this, they can often run for a very long time. So I still think, despite the, the run up, the huge run up that we've had in Make My Trip over the past few months, I still think this could be in the early stages of a move higher. And when you look at it on the daily, you could see that, we had this big run up and we sold off on volume, had a decent drawdown. I want to see how much it came down from its highs. It fell more than 20% off its highs. So that's a decent pullback. And now it's starting to reclaim those short-term moving averages. So this could be a name that could be getting back on track. And then finally, and while it isn't a developing country stock or a Chinese stock, I think Ferrari looks pretty interesting here. And this is a sort of name, Italian sports car company that could do well, even if the U.S. stocks, continue to correct for a few reasons. One, it's not a U.S. company. And also, Ferrari is a luxury good. And, if we start to see signs or evidence that maybe the U.S. consumer is coming under pressure, well, guess what? The average U.S. consumer is not buying Ferraris. This is for the ultra rich, and the ultra rich don't experience recessions or economic slowdowns the same way that the average person does. So this stock could, keep marching higher. And when we look at the technicals, I think there's good reason to believe it does. You can see it's been in a strong uptrend for quite some time here. And every time the stock will consolidate or trade sideways, it'll set up and rip higher. We can see what happened the last two times it did that, and now it's starting to build out a little bit of a base here, and it's starting to get back on track on the daily. You can see it's starting to break out of this space or a little bit, or attempt to break out of this space. We're back above the 10-day and 21-day EMA, which is what I like to use. One thing to keep in mind with Ferrari, though, is that I believe it reports next week. So you want to see how that reacts. A negative reaction, even if we run up in anticipation of those earnings, could send this lower, and maybe we'll come back down and revisit this trend line that it's formed from the lows dating back to September. So those would be a few names that I would watch in case U.S. stocks aren't out of the woods yet. And in my opinion, I think the market is still guilty until proven innocent. And that's despite the fact that we're seeing some strong moves from a lot of individual stocks. I think we need the indexes, or at least a sector ETF or an industry ETF like semiconductors or tech, to confirm that we are moving back into a risk-on environment before I want to get too excited about taking on swing trades for U.S. stocks. But anyways, that's it for today's video. I hope you found it informative, and I will talk to you guys soon.